Joining me now is Jason Helfstein, head of internet research at Oppenheimer. So there's uncertainty around AI. We've kind of seen this before with the metaverse and Meta. How much of this is kind of sentiment driven, or what is missing from the Meta equation that you would actually like to see?
Sure. So the company is basically giving you pretty explicit commentary that spending is going up meaningfully. You can compare the adjectives used this quarter versus last quarter, but the point is the street had to take up expenses meaningfully. And when you ask kind of what the return on this is, more and more it suggests that this is in pursuit of AGI or superintelligence, which it's unclear how that's going to drive the advertising business. And so you had sentiment around investments in AI driving engagement and advertising on the platform. And now there's a concern that this kind of the next level investment is more about the llama model, superintelligence, and how is that going to drive more advertising revenue? And I think that's what investors are pushing back on.
So do you think that's what's distinguishing it from, say, Alphabet here? I mean, obviously, these numbers are eye-popping. Expectations for $72 billion this year, higher figures next year for CapEx. But investors are being somewhat discretionary about what kind of CapEx they support and which ones they don't. So is it just like the figures and what they're expecting for next year? Is it exactly how they're communicating with the street on the ultimate upside for revenue? What is it that you think is distinguishing them?
I think for now, it's how it flows through the earnings. And so while investors were expecting, again, kind of big CapEx, OpEx growth for Meta for the next year or two, I think now there's a focus on it. We're forecasting Meta's only going to grow earnings per share 3% next year, whereas, Google should be 25, 26%. And so really, okay, yes, we think Meta grows earnings 17% in 2027. You really have to look forward. And so when you look at those metrics, you basically now have Alphabet and Google, or Alphabet and Meta basically trading at the same multiple, while again, over the next 2 years, it looks like Google's going to deliver, call it, 50% faster earnings growth, and they have much better expense discipline. So again, that's what I think, as you alluded in your intro comments, like, is this a repeat of the metaverse project, which I think a lot of investors, never really kind of understood the return on that. And again, I think investors do understand the return on AI, but it's at such a level that I think it's for projects that, don't even reflect the current business today.
How easy would it be for Meta to just tone down the spending a bit, turn off the spigot? Is that even an option, or are most of these CapEx plans already baked, already committed? It's, sunk cost at this point.
Yeah, it's a good point. I mean, the CFO last night, did say that the plans for next year are not 100% baked. Again, while the kind of the adjectives used to describe the level of spending got more aggressive since the last quarter, the actual budget hasn't been set. So, I mean, listen, is it possible if the investor feedback over the next 6 weeks is enough? Do they go back and relook? It's possible. I don't think it's at these price levels. I think if the stock was 15 or 20% lower, they probably would reassess.
Yeah, there's definitely a level that they would, have a more reflection on that. Meanwhile, I see headlines on the tape about a new corporate bond issuance that's gotten, a lot of oversubscription, about $125 billion worth of orders, according to Bloomberg. So clearly there's someone willing to fund this CapEx. Maybe it's in the bond market more than the stock market today. Jason, thank you so much for joining us today of Oppenheimer.